Welcome to this executive financial analysis. Today, we're tearing down some of the most stubborn myths around corporate debt. You know the ones. All debt is terrible, or if a company has a ton of cash, it's bulletproof. Well, the reality of financial architecture is a lot more nuanced than that. Understanding it is really the secret to spotting a thriving business versus one that's about to cave in. So let's dive right into the double-edged sword of corporate debt, looking specifically through the lens of solvency analysis. So is a highly profitable company actually safe? I know, it sounds like a trick question, right? But picture a company like a massive gleaming skyscraper. From the outside, the glass is spotless, the lobbies are packed, it looks incredibly impressive. That's your short-term profit. But what happens when a massive storm hits? If that skyscraper has a rotting foundation weighed down by deep structural flaws, it's going down. It literally doesn't matter how pretty it looks on a sunny day. A highly profitable company with a massive unstable mountain of debt, it's exactly the same thing. To figure out how to diagnose the health of that foundation, here's our roadmap. We'll quickly cover 1. The core concepts of corporate solvency. 2. The battle between liquidity and solvency. 3. 5 key financial ratios you need to know. 4. A real-world case study with Maujuber Hard. And 5. The anatomy of debt and risk. Let's get into it.
Section 1. Core Concepts of Corporate Solvency.
So, solvency. What are we actually talking about here? In the simplest terms, solvency is a company's ability to meet all its long-term financial obligations. It's the ultimate stress test. It's not about surviving the day, it's about surviving the decade. A solvent company has a rock-solid financial structure where its assets and its income streams are more than enough to cover those long-term liabilities. You see, it's not just about how much debt you have. It's about your enduring long-term capacity to generate the revenue and cash flow needed to actually pay back the principal and the interest over the long haul.
Which brings us to a really critical paradigm shift. Section 2. Liquidity versus solvency. Short-term versus long-term.
We've got to separate two totally distinct financial realities here. On the left side, we have liquidity. Liquidity is completely short-term. It essentially asks, hey, can we pay our bills tomorrow? It focuses purely on immediate cash, current assets, and current liabilities. But on the right side, we have solvency. Solvency is all about long-term survival. It looks at the big picture, the total debt burden, total assets, total liabilities, and total equity. Now here is why this distinction is absolutely crucial. You could have a company that is highly liquid, but completely insolvent. Seriously, they might have enough cash in the bank to pay rent this month, but their massive long-term debt means they are mathematically doomed to fail in, say, 3 years. On the flip side, a company might have incredible long-term assets, but face a sudden liquidity crunch just because they can't access cash today. For this explainer, we are focusing purely on the right side of the ledger, that long-term structural steel of the business. To measure the strength of that steel, we need precision instruments. Section 3, 5 key financial ratios. Our very first diagnostic tool is the debt ratio. The formula here is beautifully simple. It's just total liabilities divided by total assets multiplied by 100 to give us a clean percentage. Let's translate that math into actual business reality. This ratio tells you exactly what percentage of a company's assets are funded by outside liabilities. Think about it. If a company has a debt ratio of 60%, it literally means 60% of its foundation is built on borrowed steel, and only 40% is actually owned by the shareholders. And listen, if you see this ratio trending upward year over year, that is a massive, flashing red indicator that financial risk is creeping up and the company is getting way too reliant on external financing. Next up, we have a real heavy hitter, the debt-to-equity ratio. You calculate this one by taking total liabilities and simply dividing them by total equity. While the last ratio looked at total assets, this one is a direct showdown between outsider funding and insider funding. It tells you exactly how many ringgit of liability are being used for every single ringgit of equity. Basically, it reveals the company's true risk appetite. It shows you exactly how heavily the scales are tipping toward the lenders versus the owners. A super high ratio here, it means the owners are aggressively using leverage, basically rolling the dice to try and boost returns. And sure, that works brilliantly in a booming market, but it is an absolute catastrophe when things take a downturn. All right, let's look at our third metric and see how this debt impacts day-to-day operations, the interest coverage ratio. We get this by taking EBIT, that's earnings before interest and taxes, and dividing it by the interest expense. Notice how we're shifting gears from the balance sheet over to the income statement now. This ratio measures the safety cushion a company has to pay its loan interest using its actual operating profits. Think of it as the financial buffer a company has before debt payments start eating into the actual core structure of the business. If your ratio is a 5, well, your operating profit is 5 times larger than your interest obligations. You can breathe easy, right? But if that ratio starts shrinking, your buffer is vanishing. And the risk of defaulting on those loans, it absolutely skyrockets.
Now, ratios in a vacuum are just academic theory. Let's see how this actually plays out in the real world. Section 4, Case Study with Maju Berhad.
Welcome to Maji Berhad. Here is the raw financial data cleanly laid out for our executive diagnosis. They've got total assets of 1.5 million ringgit, liabilities sitting at 900,000, and equity of 600,000. Now, on the operations side, they generated an EBIT of 240,000 ringgit against an interest expense of 60,000. Oh, and they also have 100,000 ringgit tied up in intangible assets, things like patents or goodwill, which are notoriously hard to liquidate if a crisis hits. Keep these baseline numbers in the back of your mind.
And this brilliantly illustrates the reality of Maju Berhad's capital structure. If we run those numbers, their debt ratio is exactly 60%, and their debt-to-equity ratio, it's 1.5 times. Right away, these figures tell us a story. They have 1.50 ringgits of debt for every 1 ringgit of owner equity. That is a really heavy reliance on external liabilities. Now, it's not an automatic death sentence, but it's absolutely a red flag that demands incredibly disciplined management. Make no mistake, they are heavily leveraged.
But hold on, let's take a look at their operations. Their interest coverage ratio is sitting comfortably at 4 times. Remember, their EBIT was 240,000 against just 60,000 in interest. So here's the nuanced takeaway. Despite having a pretty heavy debt burden, they actually have a 4x interest coverage buffer right now. They are generating more than enough operating profit to comfortably service their debt. They're surviving. But, and this is a big but, because that debt foundation is so large, if a recession hits tomorrow and their EBIT suddenly drops, that comfortable 4x buffer is going to evaporate incredibly fast. So overall, their solvency is moderate. They're capable today, but they need to be monitored very closely.
Which brings us to a final critical philosophy regarding corporate finance. Section 5, the anatomy of debt and risk. A lot of people just assume all debt is inherently evil. That is entirely false. Debt is simply a tool, a strategic double-edged sword. On the left here, we have productive debt. This is debt used to actually fund growth, to purchase revenue-generating machinery, or to expand into lucrative new markets. This is the debt you use to build that skyscraper even higher. If the return on the new asset is higher than the interest rate of the loan, that's a massive win. But on the right, we have unproductive debt. This stuff is toxic. This is debt taken out just to cover operating losses, to pay for bloated administrative expenses, or to literally patch a leaking roof. It generates absolutely zero new value. So when you are analyzing a company's solvency, you have to look beyond the raw numbers and ask yourself, what exactly did they buy with all this borrowed money? So, to pull all of this together into something actionable, here is your definitive analysis checklist. Number 1, compare trends. Never, ever look at a single year in complete isolation. A debt ratio of 50% isn't inherently terrible, but if it was 30% last year and 10% the year before, yeah, you've got a major structural problem developing. Number 2, check the industry. A utility company building massive power plants is naturally going to carry way more debt than a lean software startup. Always compare apples to apples. And number 3, link it to cash flow. A company can show amazing accounting profits all day long, but you need actual hard cash flow to pay back the bank. Profit simply does not equal cash. Solvency isn't just a matter of checking if the lights are on today. It's about making absolutely sure the building can withstand the brutal storms of the next decade. We've seen how liquidity keeps you breathing, but solvency keeps you alive. We've explored the ratios that expose the hidden structural steel of a balance sheet, and we've learned the vital difference between debt that builds and debt that destroys. So I want to leave you with this provocative thought. How are you currently evaluating the financial stability of your own companies, or the companies you invest your hard-earned money in? Are you just staring at the shiny, profitable exterior, or are you actually digging into the foundation? Take these diagnostic tools, apply them to the very next financial report you read, and see what you uncover. Thank you so much for joining me for this analysis, and remember, always keep questioning the numbers.